Chadha, Managing Partner and Fund Manager at Complete Circle Consultants, joins us with regard to exactly that conversation. Gurmeet, good morning. Talk to us about how you're viewing the IPO frenzy. Give us the 30,000 feet view first before I start asking you on the micros on each of those.
See, I think you've got to take it selectively. I think we have one policy here that we only look at profitable companies whenever we are looking at any listings. And anyways, being a PMS manager, we are not allowed to invest pre-IPO. You only can take exposure post the listing is done. So what we have done is we eventually entered. So we entered Eternal when things started turning around. I think this was almost 12, 18 months back when Blinkit really started showing scale. So it was, I think, around 170, 180 levels. We entered Paytm almost 6 months back when it became EBITDA positive. And we are now looking at Groww if we probably get it at a better price. So I think for us, one very big metric is unit economics. And I think if you see that is something that decides whether the exponential growth on which they are valued is sustainable or not. So for example, in Eternal's case, you burned 35,000 crores to set up a food delivery business. You've technically burnt half of that to set up Blinkit, which is now becoming much bigger. So the unit economics is strong. So ability to pivot and scale up goes up. Same is the case with, let's say, something like Groww. Their 82% revenue is broking. And I was, amazed at some of the numbers these guys are doing due to intake. So, for example, quarterly SIP run rate is some 45 lakh SIPs, right? That's a big number. Now they're already in MF distribution, their market share is 13, 14%. So you have broking, which is 82%. You have MF distribution picking up. They now have an AMC. So the ability now to scale up the other businesses and reduce dependence on broking, goes up. Again, what I'm talking to is unit economics. So we look at it as unit economics, and you spread your risk, and then have 10, 12% exposure to the new age businesses. And eventually, I think in Nifty, the weightage of these new age businesses will go up. Some of them will also bite the dust. Some of them will really make it big.
Yeah. Gurmeet, hi, morning. But tell me, what is it telling you about the investor psychology right now? I mean, should one look at this as sheer appetite and strength and a show of resilience in the market that so much of flows are actually going towards new paper? Or do you think it's exuberance and foolishness?
No, I don't think so. It's exuberance and foolishness. I think we have I think some credit should be given to the entire fraternity, including financial advisors, portfolio managers, mutual fund industry. I think if you look at the SIP book, to me, this is very structural. Getting to 30,000 crores a month from 7, 8,000 crores in COVID is no mean feat. The risk is that, 60, 70% clients have come post-COVID and they haven't seen really a very bad phase. It was momentary, it was there between 21 and early 23 when things did not do well. I think we have another 14, 15 months. So I think it will be tested over next few months if markets continue to remain like that. Second, the breadth hasn't been that great. So while market is making all-time high, Aisha, if you look at BSE 500, only 37, 38% stocks are in the green. Actually, more than half of the stocks are in the red. In fact, if you see the median return, and forget about the all-time high, just the median, in case you put that is a metric, that index is actually down 6%. So I think these flows are structural. You will see more and more capital participation coming in. But yes, I worry about the supply part. I'm not just worried about the FI supply. I'm a little worried about the way so much supply is coming in through blocks and exits and FPOs, etc. I think some point of time there's some fatigue coming. So I think probably a balance needs to be maintained, and hopefully when the earnings pick up, some of these concerns will be taken care of.
Gurmeet, you spoke about how Groww is actually growing much faster than many of the traditional players in the space. Give us a sense of how one should rationalize the valuations, because it's not trading at a cheap price at all. It's trading at 20 plus times its top line, which is its sales. How do you rationalize that? And it's not just Groww, it's many of these recently listed startups, and was the case with Paytm as well. Paytm, in fact, if I recall, at the point of IPO, the price to sales was 45 times. How do you rationalize these valuations?
So I think you, as I said, you have to be selective, right? In these businesses, the cost of mistake can be very high. Groww I spoke about was, so they priced it well at about 100 rupees, there were 30 times. At this price, they're about 55, 60 times, which is expensive. If you consider, let's say, a Motilal Oswal or an Angel, you'll probably get them at one third the valuation. But as I said, the growth rate is fast. They in 10 years, they are the largest broking house. As I said, in MF distribution, they're already at 13% market. So market is rewarding growth. And that is where, they are getting what they are getting. So I think the new age businesses, you need to size them well, make a basket, do not go overboard in terms of concentration, in my view. Like, for example, it can't be 5-6% of the portfolio, right? You have let's say, a new age business at 10%, and you have, let's say, 4-5 ideas, because some of them will go wrong. You spoke about Paytm, as I said. I think they got the focus back to payment and lending. They're trying to do everything, and they were into wealth management. They were using the Paytm mall. So I think once the focus comes back, razor sharp focus came on cost control as well, employee expenses. At some point of time, in my view, the payment business will also get monetized, and I think that could be a bit of a trigger for Paytm. But for now, as I said, it's payment and lending. Then there are some good businesses like Nykaa, which is now doing a combination of hybrid model, which is online and offline. So we have like 6-7 businesses in our radar, of which we are invested in 3. In fact, I think Geo Finance is as new age as anything. I just see the way they are disbursing loans, see the way they are going about different businesses, incubating different businesses. So you create a basket, and you will get some of them wrong. But what I'm saying is that all these new age businesses today, their exposure to let's say the index top 200 is hardly in few decimals. The entire market cap before Groww got listed was 8-9 lakh crores, of which Eternal is, let's say, 3-4 lakh crores. So I think the market cap presentation will go up, and that is why it is important to participate on calculating the risk on the downside.
Right. Gurmeet, have you yourself subscribed to any of the recent IPOs or recommended so?
Unfortunately, I'm not allowed to, Aisha, being
Yeah.
a portfolio manager. But we did do some pre-IPO for Groww. We have done something for NSE on the unlisted side, on our wealth management and family office side, and we've been fairly rewarded. So as I said, if you pick good businesses, so for example, NSE today is 4.5 lakh crore market cap roughly at this price, which is trading at about, let's say, about 1900, and you have, let's say, a profitability of 14-15,000 crores, which is about 30-32 times. So if you still go by the metric in terms of company being profitable, earning visibility being there, whether it is IPO, pre-IPO, post-IPO, doesn't matter. I think where people are getting it wrong is going for immediate listing gains, going for immediate euphoria because of unlisted prices showing a big spike. Look at what happened to Tata Capital. Look at what happened to HDB. So as I said, you got to be selective, whether it is IPO or listed. Use the same metrics, which is growth and earning visibility. If that ticks the boxes, I think that's when you should go for it.
Right, Gurmeet, thanks so much for coming in.